Podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Capital. Today we are joined with Mark Curry. Mark is a seasoned real estate investor with 18 years of experience, having acquired, rehab, and sold over 120 properties valued at over 1.5 billion across multiple U.S. markets. Mark, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Sure. Yeah. Thanks for having me, Josh. Again, name's Mark Curry, co-founder of SMK Capital Management. We are essentially, we've evolved to, Josh, more of a private equity real estate investment management firm. Today, we invest in apartments, self-storage, mobile homes, and some industrial as well. And we do fund of funds. We like to diversify, spread capital across different sponsors, different operators, different locations, different asset classes. As I noted, really just trying to focus on diversification and also really looking for income and growth. We like properties that provide cash flow day one and usually have a value add plan as well. So I'll pause there. I'm sure you got a bunch of questions. We can dive into it.
Yeah, if you could give us some context, how did you get into the industry? Where did you start? What did you start in, and how did you expand your knowledge to get into multiple real estate sectors?
Yeah, sure. So I started in finance, working in corporate America as a financial analyst. Did some budgets and planning, and also some internal auditing in corporate America. While working there, Josh, I started investing in real estate on the side, like a lot of us do, buying fixer-uppers, going to them after work, going to Home Depot, spending a lot of time talking to the staff there on how to renovate. And that was 2005. And so kind of got the bug, started partnering with family members through the recession, my brothers, my parents, my uncle, my aunt, pooling capital together. And we were buying distressed properties at the time, the courthouse steps, kind of all cash fixer-uppers in a couple different markets. And did that till I decided to leave corporate America, which was in 2009, and started our company, SMK Capital Management, in 2010. At that point, Josh, we were basically an operating partner in single-family, heavy value-add deals, a lot of boarded-up properties, not producing any income while we hold them. But we renovated a ton, and I think we built a portfolio of a little over 60 properties in multiple states. But at the same time, just to add into how we got into other asset classes, we were pretty darn good at what we were doing as an operator. But I had left corporate America. I had a 401k sitting idle, no matching. As a self-employed individual, I decided to open up a self-directed IRA, trying to find a place that I could invest those dollars in outside of the public markets. Obviously, 2010, 11 was a tough time for any kind of conviction in the public markets. So I ended up going on a pretty large networking spree, I call it, for about 2 years. I was just networking my butt off, meeting people, different operators, different sponsors, and different asset classes, trying to find out where should we place our own personal capital in addition to our own deals to be more passive and get diversification. And we started investing in mobile home parks and self-storage and some larger apartment communities that had fared pretty well through the recession, 2008 and 9. And we built relationships with lots of different sponsors. For about 5 years, my family and I were investing as LPs passively in other sponsors' deals. And just comparing, by the time that period ended, we had a lot of our own deals that had gone full cycle. We had a bunch of exposure to other asset classes. And it allowed us to look at the data and kind of compare different operating partner strategies, different risk and return. And we decided to pivot. This is around 2017 now, Josh. We pivoted from being a sponsor and operating partner into more on the fund management side and syndications. And so for the past, 7-8 years, give or take now, that's been our main focus. We utilize the relationships that we've built in the industry to access deal flow. We're looking at many deals, usually 10 to 20 deals a month. We're investing in, 4, 5, 6 a year. So just looking for something specific that catches our interest and has some type of unique characteristics that make it stand out from the rest. And so, the main asset classes, again, Josh, that I mentioned before, I've been investing in for many years. A lot of the trusted operating partners and sponsors bring us deal flow. And once we find something that meets our criteria, we move forward and invest into it and raise capital from our investor group.
That's Mark. I really like your history there, especially starting out in deep value add opportunistic real estate. Because if you can scale that as an operator, anything that comes along that's already kicking off cash flow, it's almost easy because you can apply what you've learned on a managerial level and start to let it crank out in different ways. That's as far as your investors having you as the behind the scenes operator, you know in the trenches of what bad looks like and how to get it to look good. So that's huge from one operator to the next, because every different property has different scenarios, different neighborhoods, different levers you have to pull and adjust to make things work and operate and make them successful. Give us an example of a property that you may have gotten into that had a unique set of challenges that you were able to overcome.
Gosh, okay, so I've got one that immediately pops up, Josh. This was a duplex in Florida that we bought in, maybe 2008. We bought it for about 60% off what it was previously sold for just a couple of years prior. And it was built in 2005. So you could see the difference in timing there of the market. But we bought it, we rehabbed it. It was a foreclosure, paid all cash. It was a side-by-side duplex, Josh. So single story, tenants on each side. And one day I get a call from my property management company, and they say, "Hey, Mark, we've had a fire at one of the units." And I said, I thought he was joking, Josh. I started laughing. "Hey, how you been? What's going on?" He said, No, I'm serious. And I quickly set in that, sure, there was a fire, a pretty big one. Thankfully, nobody was hurt. The tenants were eating dinner with their family, and they had to climb out the kitchen window. It was just a pretty scary situation. But essentially what transpired is the tenant's car that was parked in the garage, was attached to the house, just somehow spontaneously combusted and went up in flames. It was a Ford Excursion, and basically had a total loss. I got some scary pictures of what the end result looked like. And so you have this situation where you've essentially lost your asset. Now, thankfully, we were well insured. We had loss of rental insurance coverage, loss of rent coverage. So we still received rental income from the insurance company while we waited to figure out what the outcome was going to be. And then we decided, which is maybe a suggestion and maybe something we've learned along the ways, but we decided to hire a private claims adjuster to act on our behalf. Essentially what they did, Josh, is we sired over power of attorney to them, and they went and fight with our own insurance company and to get more money and to show them that the amount of loss that they were showing wasn't substantial enough because of the amount of repairs you'd have to do to get the property back up and running. And they did. I think they got us over 70% more than we would have gotten had we not hired that private claims adjuster. And so took a bad situation, managed it for about a year, ended up getting a nice payout from the insurance company. And I think we sold the property as is for like $10,000 to a rehabber and just walked away. And so it turned out really well for our investors. But one of those things where it's not a matter of if, but when. If you're in the business long enough, something like this is going to happen.
Was that somebody giving you that guidance to hire a private claims adjuster? Because I've never heard of that. That is like really good information to now put in the belt as a tool to use.
Yeah. My father, who was my business partner at the time, he's since retired. He's been through hurricanes in Florida, and so he's done that a couple times, and it's always worked out in our favor.
Got it.
Go figure, Josh. You hire an insurance company to insure your property, and they may not always have your best interest in mind when it comes to payout.
Yep. No, especially now with insurance rates the way that they are. You've got to look at your policy and see what you need, what you don't need, and make concessions where you feel fit. But I mean, you have a freak accident, something totally happening, and hopefully you're covered to make it right. It's a lot of different things. That kind of takes us to the next part. Ask what kind of markets? What markets are you looking at? What is the what's the market look like on your horizon?
Yeah, as far as location goes, we tend to stay away from the coasts. Again, we like cash flow, we like positive income day one, and the rent to price ratios in a lot of the coastal cities just don't provide that cash flow. And they're a little bit more speculative. So where we do like to invest, the Sun Belt region, South, Southeast, and the Midwest is where a lot of our investments are, Josh. We have some in the Pacific Northwest as well.
How have your properties, your existing portfolio, held up with the interest rate environment, and then occupancy and rents and everything else that's happening right now?
Yeah, so obviously there's been a big market downturn in the last 2 years since the Fed started battling inflation and increasing rates. And they've, of course, as we all know, increased rates at the fastest pace in 40 years, give or take now. And so that has shocked the market. Almost all asset classes have been affected one way or another. We've seen, generally speaking, Josh, I think the worst is behind us. We're starting to see strong demand again. We're starting to see some rent growth again, depending on market, depending on asset class and location. But there's been, a market correction is really what we're calling it. And we're not out of it completely yet as we sit here in September of 2024. But I think we're seeing a lot of more optimism going forward. We've had some properties that have done fine and haven't really been affected, and others that have been more affected. A lot of it depends on how the properties were financed, whether they were with short-term floating bridge rate loans, and if they had interest rate caps. All of ours did, but the cost of those caps has gone through the roof, as you're probably aware. And so when it comes time to renew, you got to write a pretty big check to keep your interest rate within control. And so that has had effect. But where you have value add investments, where you can continue to renovate and increase revenue and net operating income, it's more, for, in our view, a bit of a matter of time. Like, how much time do you have? Do you have enough time to keep going? Do you have a few more years where we can keep renovating and keep growing net operating income? And that's where we've been quite successful. There's been a few properties in our portfolio. We have done loan modifications with the lenders, and they have, made it a lot more flexible to keep going with the business plan. And again, there's other assets too that have not been affected. They continue to do well. We invest in a lot of mobile home parks, for example, and I mean, we've seen pretty strong rent growth, Josh, over the last couple of years across a lot of the properties in our portfolio there, which is one of the attributes we like about mobile homes. They tend to be a bit counter-cyclical and tend to often increase in demand during tough times.
Yeah, it's like any other asset class. Have you had the opportunity, not to name any names, but to see how resilient some of your operators are through the flexes of the market?
Say the question again. Sorry.
Have you had the opportunity to see how resilient your operating partners are, your other your partners on properties, how resilient the changing of the interest rates changes? You get to see how people are, especially entrepreneurs. Whatever it takes mentality. You get to see what they can do in pressure in times of when things happen.
Yeah. Okay. Very, very good point. So, we say this a lot, but we're in the people business, and we're trying to find folks that we believe in a business plan and a strategy. But when the market changes and you thought you were going to go left, now you got to go right. How are you able to pivot? And not everybody's created equal, Josh, right? So what comes down to for us a lot of times is just pure hard work and determination to succeed. Who has it and who may not? It's not always clear, but you find out in times like this. Most of our operating partners, I'll say, we're thankful, have been busting their butts, and their asset management team continues to fight every single day to keep things afloat. As I mentioned, the workouts with some of the loan modifications that we've successfully had in our portfolio have been very helpful. So in general, we've seen, I wouldn't say all, but most of our operating partners, Josh, are doing a pretty darn good job navigating what we currently have going on in the market.
Yeah, and it truly is not for everybody, but those who can weather the storm. I mean, they'll make it to the other side, and then they can 10x from there. I mean, it's massive time to grow and really recalibrate the infrastructure, and then you've got a stronger foundation. How are you all underwriting your deals right now? What are some tips you can give if people are looking at those markets?
Sure. Yeah. I mean, I'll start with our goal for almost any investment today as to what we're looking for from a return standpoint. We want to achieve 3 to 7% in year one. That's cash on cash net to our investors. And we want that to be growing, Josh, through some type of value add strategy. So average cash on cash while we hold a deal, we're looking for 7 to 12% net to our investors. And then average annual ROI or even IRR, depending on duration of the deal, net to investors is typically around 15%. Sometimes we'll go a little lower if it's a little lower risk. Some of them are a little bit higher as well. So we're still looking for that type of return profile. Now, how do we get there is a different question. So some of the things we're looking at right out of the gate are, debt service coverage ratio, year one, day one. What are we looking at? Is it break even? Or are we at, the deal we're doing right now is about a 1.9 in year one. So really high debt service coverage there, which of course makes the deal a lot healthier. It has a lot more cash flow to provide to investors and also pay all the expenses and the mortgage every month, right? So padding there from a business viability and cash flow standpoint is really important. We look at operating expense ratios. That's another one. And just to add some context, Josh, like if you're investing in a single family home, maybe in the Midwest with one tenant in one house, you might see an operating expense ratio of 70%, sometimes higher, depending on where and tax rate and all that. And so there doesn't leave a lot of margin there. If something goes wrong or your tenant is late or they move out, you're not going to see much return at all for that year, possibly. Whereas a lot of the deals we're doing, like mobile home parks and some affordable multifamily deals that are tax exempt, we will see operating expense ratios, below 40%. And so if you're in that 30% range, you just have a lot more cushion from a business standpoint. I think about each asset as a business and how much income it produces. There's just a lot lower risk on lower operating expense ratios. I mean, there's a few others I could share too, Josh. So I'll pause though. Let you keep asking questions here.
Well, no company ever went out of business for being too profitable. That's the more cushion you have, the happier everybody is for sure. Does that kind of sway a darling investment for you, a category that you'd prefer over others?
Yeah, I mean, it helps a lot, right? I mean, just to add one more point here, a lot of times we're looking at, the spread between the going in cap rate and the borrowing rate. We want to be able to have a much higher, if we can, cap rate versus the borrowing rate. That spread is typically, 100 to 200 basis points. That's what we want to see today. It's hard to do. Some of the asset classes that kind of meet the criteria I just mentioned, Josh, mobile homes is on the top of the list next to, tax exempt apartment deals where we don't have to pay property taxes or a portion of them are no longer needing to be paid due to the structure on the deal. That really helps reduce expenses. And you also get a lot more favorable financing for those deals. Oftentimes it's 10-year fixed interest only for maybe 7 years. And you get, that financing really helps a lot. And we just did a deal that had a loan assumption, 3.57% fixed for another 5 years. And so there's unique deals out there. They're harder to find, but those are some of the asset classes. And the last one I'll mention is we've been investing lately into like triple net, absolute triple net industrial sale leaseback. And so those are unique because you have typically a manufacturing business that is operating in industrial space. And we, as the owner of the property, are leasing it back to them as the tenant. And you have annual rent escalations that go up every year, 2%, 3%, 4%, depending on the lease. and the tenant is responsible for all expenses, including property taxes. And so you have no expenses and you have an increase in revenue every year. And that's just a pretty nice recipe for growth. It has a little bit less value add that you can do there, but it's a great part of the portfolio nonetheless.
Yeah, absolute triple net. It's they pay for everything. It's true cash mailbox money. But it's coupon clipping. But at the same time, it's there every month. Should be there every month.
That's right.
And then mobile homes. How big is your all's portfolio, or how broad does that go?
So we invest in single asset opportunities, 123 Main Street, one property. And then we also invest in portfolios and funds, Josh. Some of them are over $1 billion in value across multiple asset classes. So currently, I would say the value of our capital invested in all these different investments, portfolios. And again, we're a portion of the LP capital. We're not all of it. But the value of all that real estate is, north of $3 billion at the moment. How much is mobile homes versus apartments versus self-storage? I'll tell you this: apartments are number one, and I'd say mobile homes are probably number two, and self-storage three, and industrial four.
And then on the apartments, are you all looking for the light tech deals specifically?
We look at some, but we've been more focused lately on some of the tax exemptions, HFC, PFC in Texas predominantly. And then there's a few other states now too that some of our operating partners are expanding to. But essentially, what we do there is you create an affordable component. So typically half the units, Josh, will be held as an affordable housing component, and the other half will be at market rate. And so you're keeping rents and incomes in line with the area median income. So you're providing affordable housing. And for doing so, you usually will get a tax exemption. It can be 100% tax exempt for 99 years. It could be 50%. It just depends on the structure. But that's definitely an area we've been focusing heavily on.
The public-private partnership, those can help the communities out a ton, and really all the way down the line, like you had said. And there's banks that they technically need to invest into those type of projects in order to keep their score in line as well. So they're highly sought after. Tell us about a recent investment and why you chose it.
Yeah, I'd say the most recent one, scheduled to close later this month, is an apartment deal just south of Dallas, Texas. We love Texas. We've been investing there for over a decade. Just, there's different areas of Texas, of course, but the Texas Triangle, you tend to see consistent growth from a population standpoint, from net in-migration. You see, there's actually more natural births in Texas than there are people moving in. And so long-term stability, a lot of jobs moving there, companies moving there, relocating there. A lot of the data points to Texas, Josh, but we like this deal for a couple reasons. It made it kind of stand out from all the rest. The first, it was a tax exemption, 50% property tax exemption. At the time of closing, the tax bill gets cut in half, which is a pretty substantial increase in net operating income day one. The next was a seller is essentially not distressed, but they are forced to sell. They operate a fund, and their 5-year duration is up. And so they actually got an offer on the property last year for about $5 million more than what we were paying. And so we got a 16% discount from 2023 pricing, which is quite favorable. And the next kind of attribute about this one, Josh, you have the ability to take the seller's loan. And so they bought the property 5 years ago. There's 5 years left on the loan. It's assumable. It's fixed at 3.57% for the next 5 years. And so the business plan on this one, it's a 1986 vintage asset, Josh, 200 units. Great property. I've been there, viewed it, walked the units, met with the management company that's on site now. And it's got some nice amenities there as well. Pretty quiet neighborhood, very well located. but you have outdated interiors. And so there's an opportunity to come in and renovate all the units, which is the business plan, grow revenue and NOI. And so we like that kind of starting out point. You have a lot of favorable attributes from a positive cash flow standpoint, and also the growth potential from the kind of the forced depreciation that we're planning to pursue into the property.
Yeah, and renovations, they can go from just a light rehab to bring them up a little bit, or deep rehab and everything's brand new and it's totally different look, feel, and touch, and you can achieve higher premiums, one or the other. That's what did you all have to do to accomplish the tax cut?
What do we have to do to accomplish it, you said?
Correct.
So this is going to be a 50% of the property will be kept affordable by definition based on the local area median income. And so we'll have some rent and income restrictions that people need to qualify for. They still have to have jobs. They still have to apply, but you're essentially lowering the bar as to how much income they may need to have to be able to rent one of the units. And so providing affordable housing and then getting that property tax exemption and doing so.
So you can still do your voucher overhang strategy on affordable and still get your market rates. So it's there's different ways to make it all work and to still be in compliance, and that's the beauty of it. Just and the checks come in guaranteed every month, so it can be coupon flipping as well. Very cool. Mark, if somebody wants to reach out to you, learn more about your company, possibly invest alongside of you, how can they get hold of you?
Sure. Yeah. I'll give you our website and also my email, but the website is smkcap.com. Again, the company name is SMK Capital Management. People can sign up there, Josh, to join our investor group. And they can also email me. I'm happy to chat. We make it an effort to talk to every one of our investors several times before doing anything together, get to know them, see what their risk tolerance levels are, what their goals are, income, growth, etc. But my email is, you can send an email to info@smkcap.com.
Great. Mark, we certainly